When I first started investing, it honestly felt overwhelming. Back then, all I ever heard about was single stocks. It was like every conversation was about which company to buy, which one was the next best thing, or which one was about to crash. And honestly, it felt like guesswork. If you picked right, you look like a genius. If you picked wrong, that's your money gone. But what I didn't realize at the time is there's a whole nother world of investing. A world where you didn't need to be glued to the stock charts or try to predict the next best winner. And that world is the world of ETFs, exchange traded funds. And when I first discovered them, it felt like a weight lifted off my shoulders. Suddenly, investing wasn't about guesswork. It became simple, automatic, and something I could set and forget. So, in today's video, I want to share the 3 ETFs that I personally invest in, why I chose them, and how I've structured my portfolio around them. And just to be clear and upfront, this isn't financial advice. This is just my personal strategy. And I hope by sharing it, you get some ideas that might help shape your journey. So, let's jump into it. My ETF portfolio is split across 3 funds: VAS, VGS, and NDQ. Each of these plays a different role in my portfolio. VAS gives me exposure to Australia, VGS gives me global diversification, and NDQ, that gives me growth and innovation in the tech sector. So let's break them down one by one. First up is VAS, the Vanguard Australian Shares ETF. So what exactly is VAS? It's an ETF that holds the top 300 companies on the Australian Stock Exchange. Think of it as owning a slice of the biggest and most established businesses in Australia, all bundled into one simple investment. And that means with one trade, I get exposure to companies like Commonwealth Bank, BHP, Woolworths, Wesfarmers, and CSL. Basically, the backbone of the Aussie economy. Now, why do I dedicate 40% of my portfolio to VAS? There's a couple of reasons. Reason number 1, dividends. When I first started out, I was so anxious on dropping a few $100s into investments. Analysis paralysis was a real thing for me. And honestly, knowing that VAS paid dividends helped calm me down every time that check hit my bank account. See, Aussie companies tend to pay higher dividends compared to a lot of global companies. So when I invest in VAS, I'm not just relying on share price growth. I'm also getting regular cash payments in the form of dividends. And here's the kicker. Those dividends often come with franking credits, which makes them more tax effective for Aussie investors. That's something unique to the Aussie market, and it's one of the big reasons I want to keep a solid portion of my portfolio in local companies. And reason 2, home bias. Now, some people will argue that investing too much in your home country is risky, and they're right. Australia is only about 2% of the global stock market. But here's my personal view. I live here, I earn here, and I'll probably spend my money here for most of my life. So I like having meaningful exposure to the market that directly impacts me. And reason 3, simplicity. If I wanted to stop here and only hold VAS, I'd still be investing in hundreds of companies across different industries. That's a lot more diversified than buying 1 or 2 single stocks and hoping they perform well. So for me, VAS is the foundation of my portfolio. It gives me stability, income, and exposure to the country I know best. Next up is VGS, the Vanguard MSCI International Shares ETF. If VAS is about home, VGS is about the world. This ETF gives me exposure to over 1,500 companies across developed markets. And we're not just talking about a handful of names. This is the who's who of the global economy. I'm talking Apple, Microsoft, Amazon, Nestle, Johnson & Johnson, Toyota, and Samsung. The list goes on. Basically, the largest and most reliable businesses from the US, Europe, and Asia. Now, why do I put 40% into VGS? The answer is simple: diversification. As I mentioned earlier, Australia makes up only 2% of the global market. That means if I only invested here, I'd be ignoring 98% of the world's opportunities. By holding VGS, I get to own companies from all over the world without having to pick them individually. Here's another way to think about it. When I invest in VGS, I'm effectively owning a slice of the global economy. If the US grows, I benefit. If Europe recovers, I benefit. And if Asia continues to expand, I benefit. No single country makes or breaks my portfolio. Now yes, VGS is heavily weighted towards the US. Around 2/3 of the fund is in the US companies. But, to me, that's not a bad thing. The US is still home to many of the world's most innovative and most profitable businesses. And at the same time, I like that I get exposure to regions like the UK, Japan, and Switzerland. And let's not forget sheer scale. By investing in VGS, you own companies that are literally shaping the world. For example, think about how often you interact with these businesses on a daily basis. The phone in your pocket, the software on your computer, the food in your pantry, or even the car you drive. There's a good chance one of those products is linked to a company inside VGS. So for me, VGS is about ensuring my portfolio isn't just limited to what's happening in Australia. It's about spreading the risk across the globe and capturing growth wherever it happens. And then we come to NDQ, the BetaShares NASDAQ 100 ETF. Now this one's a little different. It's not about broad diversification. This is more a focused bet on technology and innovation. See, NDQ tracks the NASDAQ 100 index, which is made up of the 100 largest non-financial companies on the NASDAQ exchange. So what does that mean? It means exposure to some of the most iconic and fast-growing companies on the planet. Think Apple, Amazon, Microsoft, Google, Tesla, Meta, and Nvidia. Basically, the big names in tech that are driving the future of how we live and work. Now here's why I include NDQ in my portfolio. See, I genuinely believe that technology is going to continue to shape the world, from AI to renewable energy or cloud computing. So much of the innovation we rely on comes from companies in the NASDAQ. But, and this is a big but, tech can also be extremely volatile. We've all seen how quickly tech stocks can rise, but also how quickly they can fall. That's why I only allocate 20% to NDQ. This way, I get a meaningful exposure to tech growth, but it's not so large that my entire portfolio rides the ups and downs. To put this into perspective, let's say NDQ grows at 10% a year while my other holdings grow at 6%. That extra boost helps lift my overall portfolio. But if NDK drops 20% in a bad year, my overall portfolio doesn't get wrecked because it's only a fifth of the total. So in short, NDQ is my growth kicker. It adds excitement and future potential to my portfolio without overwhelming it. So, let's put it all together. My target allocation is 40% VAS, 40% VGS, and 20% NDQ. For me, this mix feels balanced. It's diversified across different markets and sectors, it's simple to manage, and it gives me confidence to stick with it long term. And the best part, I don't have to overthink it. I don't need to chase stock tips or guess which company is going to beat earnings this quarter. I just automate my contributions into these ETFs. I let it compound and I focus on the long game. And that's my ETF strategy. Simple, diversified, and designed to run on autopilot. Again, this is just what works for me. It's not financial advice and it might not be the right mix for you. But I hope sharing my thought process gives you some ideas on how you can take it into your own research. And if you got value from this video, hit that like button, subscribe for more investing content, and let me know in the comments, what ETFs are you currently holding? I'd love to hear your approach.